Let's take a look at NVIDIA and see if we could find out if the company is a good value or not. First, we need the market cap, and we'll put that into the model, 219.4 billion, and then the stock price of 356.8. And now the shares outstanding is just the market cap divided by the stock price. That gives you 615 million shares outstanding. And to calculate the intrinsic value of the stock is we estimate the future free cash flows of a company, then discount those numbers back to today's value. That way we have the value for the entire company. Then we take that number and divide it by the shares outstanding, the 615 million. And that gives us the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's a buy or a sell. So let's get the actual free cash flows for the company, because that needs to go into the model. So we'll go to the finance section of Yahoo, and then go to cash flows, and then pull the free cash flows for the past 4 years. And free cash flow is the cash that's remaining after operating a business. So if you have positive cash, that means you're adding value to your investors. You're operating a business, then adding cash to your balance sheet. Net income we also need for the model, and that's your profit or loss for a given time period. But we don't forecast net income because net income has a lot of non-cash items in it, so it's not good for forecasting purposes. But cash flow is. And next is total revenue. That's just the sales for a given time frame. So there's no negative numbers, which is good, because sometimes when you have negative numbers, it makes it really hard to value the company, because the way you value a company is you have to look at previous numbers in order to forecast the future. So let's figure out the capital structure in NVIDIA, and we need to first get the interest expense. That's the interest they pay on a debt. That's $52 million. And now let's go to the balance sheet to see how much liabilities they have. So they have no current debt. Long-term debt is 1.9 billion. So they pay 2.61% interest on their debt. Interest is tax deductible. So let's find out their effective tax rate so we can deduct the interest payments. So it's kind of hard to get a good read because we're looking for the income before tax and the income tax. And if they have a negative income tax, that means they got a refund that year. So we can't use that one. So it looks like the best one is 2017. So 1.9 billion income they made, and they paid 239 million in taxes. So they paid about 13% of taxes. So the cost of the debt is 2.3%. And they only have 1% of debt in a capital structure. That's really good. You want a little debt, less the better generally, and 1% is great. So let's find out the beta, because we want to see the volatility of the stock so we can calculate the cost of equity. And it's a pretty high beta, 2.03. That means it moves twice as the market moves. So you generally don't want a volatile stock. It does increase your weighted average cost of capital. So the WACC, the way we calculate it, is a blend of the cost of equity and the cost of debt. You can see the cost of equity is so high, it's almost 18%. The cost of debt is 2.3%, so much lower. Because debt is a lot safer than equity. Because in the event of a default, debt holders are paid before equity holders. And also debt holders get a guaranteed interest payment, where equity holders may get a dividend, they may not. So the WACC is what we're going to discount the cash flows by. It's about 18%. So we're going to discount the expected future cash flows. We got that for 4 years. And then we did a terminal value, which is all years past year 4. And we discounted those numbers back to today. And we got a value of the company of $86 billion. And we divide that by 615 million shares. We get an intrinsic stock price of $140. So it's trading at 155% premium. It's trading more than double what the calculated stock price is. And so it's definitely a sell according to the model. You can see the historical chart. And let's see how the stock actually traded the past few years, if it was trading above or below intrinsic. So we know it's at about 350. So it looks like it was trading much closer to intrinsic value, around 150 a year ago, but it really shot up. Even during coronavirus, it's been going up dramatically. So that just means people are willing to pay more for this company, more than it's worth, because they see the future of the company better than the financials indicate. So when more and more people want to buy a stock, it really pushes the price of the stock higher and higher. So a lot of people think a stock price is based off of the financials and what a company's worth. It's not. It's based off of supply and demand of the market. That's what indicates stock price. Financials may help or hurt a stock price, but it's just it's not the real result of the stock price. So people need to keep that in mind, and that's more evident with companies that are losing money year after year, but yet their stock prices keep going higher and higher, like Tesla. So let's look into the ratios. We'll get a little more color on a company. And I got to go back to the balance sheet to get some information in order to calculate some of the ratios. So let's go to the balance sheet. Let's get the current assets. And that's $13.5 billion. That's assets that can be converted to cash within 12 months. That's why they call it current. And current liabilities are liabilities that are due within 12 months. And stockholders' equity is the total assets minus total liabilities. And that's like the value of the company according to the balance sheet. Well, they have a crazy high current ratio. See, their numbers look really bad. A PE is one of the most common ratios. That's price of the stock over earnings per share. Earnings per share is net income over shares outstanding. And I look for 15 or lower when I invest in a company because I want to value a company. I don't want a company that doesn't give me any value that I'm hoping the future gives me value. I want them to prove they're worth it now. And when it's 78, that's like saying investors are paying $78 for $1 of profit. So this could be because they're in a growth mode, growing a company, and that could happen with either newer companies or companies that are actively trying to grow their business and invest. So it's not a good sign so far. Let's see the price over sales. Sometimes people use that if a company has a PE that doesn't really work. And that I look for under 2.2. That's the stock price over the sales per share, and that's over 20. So this is an overvalued stock according to these ratios so far. The price to book ratio is the price of the stock over the book value per share. Remember, the book value is the equity, is the assets minus liabilities. And 18 just indicates it's really a weak company according to its balance sheet. It's possible the assets, if you look at the assets, you might get more color on this, but that's definitely a really high number. And they have a current ratio of over 7.5. You want generally a current ratio between 1.2 and 2. Current ratio is how you can fund your short-term liabilities. So it's the current assets are cash and accounts receivable and inventory. And those are the three assets that can be converted to cash pretty easily. So if you needed cash to pay debt or to pay your payables, that's how you would get it. Under 1 is really bad, but having too high a current ratio indicates they just have a lot of cash or a lot of inventory or receivables that they're sitting on. And we don't invest in companies so they just sit on cash or sit on money that's due to them. We invest in companies that can generate a profit. So that's not a good sign either. ROE, they have a good ROE, 23%. We want our ROE above 20%. That's how they're using their equity funding, how efficient they are in generating business from the equity. So when you look at these ratios, you want to compare a company over several quarters to see how it changes. Also, you also want to compare it to similar companies in your sector. Like you can't really compare it to McDonald's because maybe the fast food industry has a PE ratio of, I'm just making it up, 20. That's a good PE ratio, but for a company like NVIDIA, 30 may be a good PE ratio. So you have to compare it to similar companies. Unfortunately, I did a discounted cash flow model for Intel, which is their competitor. So the more DCF models I do, the more information I have to provide on videos. So I'm comparing Intel, which is INTC, and NVIDIA's ratios, and the winner, whoever's a better ratio. You can see Intel has a great PE. I prefer under 15, but 15.8 is fine. The price of sales isn't great, but it's so much better than NVIDIA. The price to book is much better. It's interesting that current ratio is under 1, so that indicates they're going to go into debt this year in order to fund their current receivables. Unless they're going to have a windfall of cash come in or a lot of new business come in over the next few months. That is possible. But so I guess NVIDIA wins the current ratio war, so to speak. Intel has a better ROE, but they're really close. And NVIDIA wins in debt. They only have 1% of the capital structure is debt, but Intel has 10%. But if you think about it, Intel is using its money wisely. So debt isn't bad. It's kind of like if you take a mortgage to buy a home, that's good debt because you have an asset. Now, if you take a loan to go and buy a car and go on vacation, that's bad debt. So debt doesn't have to be bad. It's how you use the debt. And you don't want too much of it. So 10% isn't bad. So they're probably using it smartly because you can tell with their ratios. So Intel, according to the ratios, looks like a buy, and NVIDIA does not look like a buy. And even according to the DCF models, NVIDIA is definitely not a buy. But let me know in the comments what you think. If you have any other ideas of ratios I need to look at or other businesses you think would be good for this type of analysis. Thanks for watching.